Housing is becoming less affordable every single day. For most of 2023, both home prices and mortgage rates have been going up. And for many Americans, the dream of homeownership seems to be slipping away. But what if I told you I could get you into any home on the market today and you would have the same net monthly payment as if you were buying a house at a 5.5% mortgage rate, even though mortgage rates are actually above 7.5%? Well, as you're about to see, it's a lot easier than you think. And if you know what you're doing, home buying is still very attainable for everyday Americans. My name is Michael. I own a local real estate brokerage here in the Dallas area. And if you're looking to make a move in the Dallas area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, so every day I talk to home buyers, and their biggest issue is always the monthly payment. It's not actually the mortgage rates, it's not actually the housing prices, it's the monthly payment. They know they have a check coming in every 2 weeks for X amount of dollars, so they need their mortgage to be below X amount of dollars. So what we really have is a cash flow issue. Now, I also hear from my buyers pretty consistently that if rates were down at a 5.5%, they would be buying a home today. So in today's video, we're going to be exploring how can we get your monthly cash flow situation worked out so that the money leaving your account every month from your mortgage is the same amount as if you were buying at a 5.5% mortgage rate. In today's example, we're looking at an actual buyer who is buying a $600,000 home, putting 5% down in Dallas with a 760 credit score. If you look here, the difference between a monthly payment at a 7.5% rate to a 5.5% rate is about $750 a month. So when you're saying if rates were down at 5.5%, I'd buy a home today, what you're really saying is if my monthly payments were $750 a month lower, I would be buying a house today. And I'm about to show you it's a lot easier than you think to get there. Now there are many ways to get there and it would take me hours to cover them all. So today I'm just going to show you one real life and pretty common example that will get you there. And this video is probably going to be a little longer than normal, but I promise you the longer you watch, the more money you're going to save. So if you want to save the most money possible, you've got to watch until the end. Things we're going to be covering in this video are strategies involving temporary rate buydowns, permanent rate buydowns, PMI buydowns, insurance, property taxes, and other debt. And other debt is actually a really big one that applies to most of you whether or not you're even buying a home. So make sure you don't miss that one. Okay, let's start out with a temporary rate buydown. This is paying down a lump sum of interest at closing to have a way lower payment in year 1 and year 2. In today's example, we're looking at a 2-1 buydown, which means in the first year, you'll have a 2% lower mortgage rate. In year 2, you'll have a 1% lower mortgage rate. And in years 3 through 30, you'll have the full 7.5% mortgage rate. So in year 1, you've got that full $750 a month difference covered because you're actually at a 5.5% rate for year 1. But come year 2, you're $375 a month short as your rate goes up to 6.5%. And then of course, years 3 through 30, you're short that full $750 difference. So for most of you, this is not going to be the winning strategy, but I wanted to bring it up anyway so you're aware because I've actually had several buyers use this year. So who is a temporary rate buydown good for? There are two types of people this works really well for. The first is buyers who believe that they're going to be making a lot more money in the coming years. Typically, this includes people who are at the beginning of their career who have a clear and certain growth path in their industry or at their company. The second group this works for is people who believe that rates are going to come down below 7.5% at some point in the next 2 years. And one reason this has been popular with my buyers is that this buydown has to be paid for by the seller. Not one penny of it can be paid by the buyer. Additionally, on our 600K example, this is the cheapest option of what we're going to cover today. To get the seller to buy down all of that interest, you would only be asking the seller to pay $13,000. And believe me, there are plenty of homes sitting on the market right now that would be willing to pay $13,000 to cover this for you. So you've got 2 full years of heavily reduced monthly payments, and you're just betting that rates at some point in the next 2 years will be lower than 7.5% and you can refinance before you ever get to year 3. So that's our first option, but obviously most of you are going to want something permanent. You don't want to take a gamble on what rates might do over the next 2 years. So for that, let's move on to our next option. This is the permanent rate buydown. Just like it sounds, you're spending an amount at closing to permanently buy down your mortgage rate for the entire 30-year period. And for our next 2 examples, we're going to be assuming that you're getting maximum seller concessions from the seller, which on a conventional loan is 3%. So on a 600K home, a seller can contribute up to $18,000 towards your closing costs, or in this case, buying down your rate. Basically, I'm trying to show you if you were to get all the money that you could from the seller, what could you accomplish with that? But I also want to tell you there are diminishing returns to buying down the rate. The more you spend, the smaller the benefit gets. gets. But for the sake of keeping this video as simple as possible, let's just assume we unload all $18K onto just straight up buying down the mortgage rate. That would get us from a 7.5% rate down to a 6.7% rate. Now here's something very important that a lot of buyers don't account for: the tax benefit. Paying higher interest means having bigger tax deductions, which means big tax savings. Looking here at a 5.5% rate, your tax benefit would be about $700 a month. But looking at the permanent buy down option, using all $18K to permanently buy it down, when our rate is at a 6.7%, our tax benefit is about $130 a month more than if we had gotten a 5.5% rate. So instead of having to overcome that full $750 a month figure we've been talking about, it's actually only $620 a month after you account for the tax savings. Now, before you go saying, that's not a monthly savings, I'll have to wait until I get a refund at the end of the year. I've actually had clients go to their HR departments and ask for their withholdings to be adjusted accordingly, and it's worked. Now, will your company do that? I have no idea. But your worst case, I guess, is you will get it as a tax refund at the end of the year. So now the figure we're trying to overcome is only $620 a month. And after buying down our rate to the 6.7%, that saves us an additional $307 a month. So as of now, we're still $313 a month short to feeling like we got that payment from a 5.5% rate. Although you've got to admit, $313 already feels way better than $750. So we've still got $313 to overcome, but we're gonna come back to that later in this video as we've actually got a better way to spend that initial $18K that we're getting from the seller. So next up is our PMI buydown plus permanent rate buydown. PMI is a mortgage insurance that you have to pay anytime you put less than 20% down on a home. So in this scenario, we're taking the $18K we got from the seller, we're spending the first part of it to buy down the PMI, which in this case lowers the monthly payment by about $175. Then we're taking the rest of the $18K and using that portion to do the permanent rate buydown. And since some of the money went towards the PMI buydown, in this scenario, we're only able to buy our mortgage rate down to a 7% instead of the 6.7%. But even though we have a higher rate, as you can see, our savings is still higher. And so, compared to the previous example of 6.7%, since we're paying more interest now, our tax savings is actually higher. So now instead of the $130 a month saved, we're actually at $163 a month saved, as you can see in the difference between these two numbers. So instead of starting at $750 a month to overcome, after the tax savings, we're already down to $587 a month. So starting at $587, we then subtract our $345 a month saved by buying down our PMI and buying down the mortgage rate with that same $18K. So just by using the same $18K a little differently, we're saving an additional $71 a month compared to just straight buying down the rate. But as of now, we're still left having to overcome $242 a month. So what are some potential options to help offset this $242 a month in your monthly budget? The first is insurance. Insurance is one of the biggest ways that people overpay for their mortgage. And it's mostly because people have never had to pay homeowners insurance before, so they don't know what a good deal is. They may get one or two quotes and say, they're pretty similar, I'm just gonna assume that everyone else is in that same ballpark. But by really shopping around, you can easily save $100 a month. I've done this more than once. You could also take a higher insurance deductible. Getting a super low deductible greatly benefits the insurance company because your monthly payment goes way up. What I do is I just self-insure. So I just keep that extra $100 or whatever it is a month. Instead of paying it to the insurance company, I just pay it to myself. If nothing happens that year and I don't have to pay my deductible, I keep all of that money instead of the insurance company. But again, even without changing the deductible at all, just by shopping around for the exact same coverage, you can easily save $100 a month. And I personally always recommend starting with whoever you have your car insurance with, as they're going to be able to offer you some kind of bundle right out the gate, and that'll give you a good point of reference. The next thing you should be aware of is property taxes. In the state of Texas, starting next year, every single person who has a primary residence is on average going to save about $125 a month. That's just coming from our Texas tax reform here, and if you want to learn more about that, you can watch this video here. But the odds are, when you're looking at home buying calculators, they're estimating your taxes as if the city has assessed it at the full purchase price. This is almost never the case. It's not uncommon for a $600,000 home to be assessed by the city anywhere from $450 to $550. So if you're buying a $600K home and the city has assessed it at $500K, this alone is going to lower your monthly payment by $200 a month versus your expectation from that mortgage calculator. So if you're using a mortgage estimator, it's very likely it's already estimating at least $200 high. And I know at this point you're thinking, that's great to know, but what if I can't find lower insurance? And what if the city actually does assess my home at the full value? How can I for certain overcome this remaining remaining $242 deficit in my budget? Well, the easiest way for most buyers to ensure lower monthly expenses is by addressing other debt. Most people buying a home have at least one car payment. In fact, the average monthly payment for a new car here in America is $729. So let's say you bought a $45,000 car and you've been paying it off for the last 2 years. Your monthly payment is about $750 a month. But as of today, you only owe $25,000 on the car. You can now refinance that remaining $25,000 to a 60-month loan, and your payment goes from $750 a month down to $450 a month. With that one easy step, you've just solved the remaining $300 of your cash flow issue. And in reality, most of my buyers are couples who both have a car payment and both have owned their car more than 2 years. In this scenario, both of them refinancing their cars alone saves them $600 a month. So they've just solved $600 of the $750 a month cash flow issue. Now, all they would have to do is spend a few $1,000s buying down their PMI, and they've solved the full $750 a month, and their monthly mortgage is going to feel exactly like it would if they had just bought at a 5.5% rate. Now, I know not all of you have a car payment you can refinance, and I know that I just covered a ton of information very quickly, and you might have even more questions now than when you started watching. And again, this is only one scenario, but the point is just to show you, even with rates up at 7.5%, home buying has not become impossible. All you need to do is hire the right team of problem solvers to get you there. You may know that not all real estate agents are created equal, but you need to know it's the exact same for lenders. If you're looking to buy here in the Dallas area, call me up and I'll connect you with a great lender, and together we'll help you troubleshoot your situation just like in this video. And if you got any value from this video, please give it a thumbs up so more people can see it. Thank you so much for watching. Call me with any questions you have. Thank you for watching, and I'll see you in the next video.